Hello, sir. Hope you all are doing well. It's me, Fahad, your ACCA Financial Management Tutor. Sir, today we would be discussing our Doe Company December 2007 investment appraisal question. Sir, let's read the question. Okay, sir. Doe Company need to increase the production capacity to meet the increasing demand for the existing product, which is used for the food processing. A new machine which has a useful life of 4 years and a maximum output of 6 lakh kg of an Congo per year could be bought for rupees 8 lakh payable immediately. Sir, to increase our production capacity, we would be buying a new machine which has a life of 4 years and which gives a maximum output of only 6 lakh. The new machine can be bought for rupees 8 lakh payable immediately. The scrap value of the machine after 4 years would be 30,000. The forecasted demand and the production for the next 4 years is as follows. Okay, sir. Then the forecasted demand are as follows. Like A1, there is 4 year A1, A2, A3, and A4. The demand for the year 1 is 1.4 million, demand for year 2 is 1.5, demand for year 3 1.6, and demand for year 4 is 1.7. The existing production of the Congo is limited to 1 million. So existingly, our old machine produced 1 million and our new machine can only produce only 6 lakh, which means sir 0.6, which means that our total production would be 1.6 million. Our total production capacity would be 1.6 million. Sir, we cannot produce anything beyond 1.6 million, although we can produce it under 1.6 million. It means we can produce 1.4 million, we can produce 1.5 million, we can produce 1.6 million, but we cannot produce 1.7 million. We can only produce 1.6 million. Okay, sir. Then moving forward, uh, the current selling price would be 8 per kg and the variable cost of the material is 5 per kg. Other variable cost of the production is 1.9 per kg and the fixed cost associated with the new machine would be 2,40,000 in the first year and it would increase 20,000 per year in each of the subsequent year of the operation. Means sir, in the first year of the production our fixed cost would be 20,000 and similarly it would be 2,40,000 and similarly it would be increasing by 20,000 each year. Okay, sir. Then moving forward, due company pays tax 1 year in areas. It means that sir, it pay tax after 1 year of earning the operating profit at an annual rate of 30%. It can be claimed a capital allowance at the rate of 25% reducing balance method. Sir, as we read earlier, as we knew that it can also get a tax benefit at the rate of 25% using a reducing balance method. So that we have to calculate a capital allowance schedule, made a capital allowance schedule, and calculate the tax benefit for each of the 4 years. Okay, sir. Then moving forward, the balancing allowance is claimed the final year of operation. So the remaining amount means the remaining amounts you can claim in the final year of the operation. Okay, sir. Balancing amount you can claim in the final year of operation. Okay, sir. What do you mean by the balancing amount, sir? The balancing amount mean that the scrap value, sir, the scrap value of 30,000, you can claim the 30,000 at the end of the year. Due company can also use the weighted average cost of capital operating the investment approach. It has an equity of 11% before tax, cost of debt is 8.6%. Long-term finance on the market value on the basis of 80% equity and 20% debt. So the long term it has finance the money from outside in which means it has to pay 80% at its equity and 20% from its debt. Therefore, the cost of the equity is 11% and before tax cost of debt would be 8.6%. So we would be using 11%. Okay, then required we have to calculate the net present value of the new machine and advise or state whether the new machine would be acceptable. It would be acceptable to accept the new machine. Then the part B, we have to calculate the internal rate of return of the new machine and advise whether it would be feasible to accept the project. Okay, so then the part C, we have to distinguish between the risk and uncertainty in this context of investment appraisal and describe how the sensitivity analysis and probability analysis can be used to incorporate risk and uncertainty in an appraisal process. Sir, you guys please read the question, then we will be continuing the question. Okay, sir, before moving forward, I think you guys have read the question. Let's move. Okay, sir. Initially, we have to write how many years do we have. We have year. Wait a minute, sir. How many years do we have? We have 4 years. Year 0, year 1, year 2, year 3, and year 4. Then the demand for the year 1. So we are only appraising the Korean investment project, which has a maximum capacity of 6 lakh units. So 1 million unit would be produced by our old machine. Then the new machine would only produce 4 million, which means sir, we have to calculate it in thousand. So I would be multiplying 0.4 is equals to 0.4 into 1000, which means 400 for the first year, 500 for the second year, and 600 for the third, and 700 for the third year. Sir, we have to calculate it in the nearest thousand. Therefore, I have, instead of writing 4 lakh units, 400,000 units, I have write in nearest thousand, which means 400, 500, 600, and 700. Then, sir, our selling price. Instead of writing selling price, I would prefer to write as sales, our total sales. Then our variable cost of material cost. So our material cost. Then our variable cost of production. Then it then after calculating this, we would be reach up at the contribution margin. Then fixed cost, we have to reduce or less the fixed cost. After reduction of the fixed cost, we would reach at net profit. Then from net profit, we have to deduct tax paid amount. Then from tax paid, we have to also add the tax benefit which we would receive from capital allowance using reducing balance method. Then after tax benefit, tax paid, here comes our working capital. Then after working capital, sir, altogether it comes our net cash flow. Sir, I would recommend you all guys to just memorize the format before starting the question. Then from discount rate and net present value. Okay, sir. I think we should continue the question. Sir, our selling price for A1, it's 8 8 per kg. It is 8 per kg, and we have 400 kgs, which means 3200. And similarly, I would multiply 8 with 500, 8 with 600 kg, 8 with 700 kg. Sir, I have mistakenly write 700 kg wrong. because our maximum capacity would be only 600 kg. So instead of 700, I would write 600. Then sir, our material cost is sir 5 per unit, so 5 per kg. So it would be 2000 for the first year, and similarly it would be 2500 for the second, 3000 for the 3000 for the third, and 3000 for the fourth. Then similarly sir, our variable cost is 1.9 per kg, and we have 400 kg in the first year, which means 760 for the first year, and similarly 950 for the second, and 1140 for the third, and 1140 for the fourth. Okay sir, then adding all of up together, we would get contribution margin of 440 for the first, and 550 for the second, 650, 660 for the third, and 660 for the fourth. Then sir, for fixed cost, the examiner has tell you that you have fixed cost of 2,40,000, which means you have fixed cost of 240 for the first year. Then this fixed cost of 240 would increase by 20 each year, which means 260 for the second, 280 for the third, and 300 for the fourth year. Then adding up all, we would reach at 200 of our operating profit for the first year, 290 our operating profit for the second, 380 and 360 are operating profit for the fourth year. Okay, sir. Then after reaching at an operating profit, sir, uh, we would be paying tax at the rate of 30% in areas. Areas mean, sir, for operating profit of 200 of the year one, I would pay tax at year two, which means, sir, at 200, I would be paying 30% in year two, and for 290, I would be paying operating profit for rupees for 87, and similarly for 114 and 108 at year 5 for an operating profit for year 4. Then sir, we would make a capital allowance schedule. Sir, we would make a capital allowance schedule, which mean year depreciation and tax benefit. Sir, we would have 4 years, 2, 3, 4 and 5 year depreciation. Sir, the examiner says that you would have a scrap value of 30,000, and your sir working capital would be 8 lakh, which means your working capital of 800 minus 30, and you would paying tax at rate of, and you're reducing balance at a rate of 25%, which means 193 for the first. Then 193 would be calculated multiplied by 0.75, 75%, then with 0.8, 108. Sir, then you will write here your carrying value was, sir, your carrying value is was rupees 800, and then your accumulated depreciation is 445. Then your written down value would be 800 subtract with 445, it came out with 355. Then you would subtract your scrap value, which means your scrap value would be 30. After subtracting your scrap value, you would be getting accumulated depreciation for the fourth year would be the remaining depreciation, which means 325. So you would be getting tax benefit of 30% at 193, which means 30% of 193 would be 58, then similarly 43, then 32, then 97. Then I would link all these figures. I would get a tax benefit of 58 for the first year and 43 for the second year, then 32 tax benefit for the third year, then sir 97 for the fourth year that I would be getting in the fifth year because it is in areas. So then our working capital is 800 that I would pay before starting our project at year zero, and the scrap value that I would receive at the end of investment project, which means our investment project would last at year 4. The scrap value I would receive is 30. After adding all these figures, I would be reached at our net cash flows would be 800 for year 0, 200 for year 1, 288 for year 2, 336 for year 3, 600, 308 for year 4, and 11 negative 11 for year 3. So as you know, we have read that our cost of capital equity was 11%. So we would our target profit or target equity is 11%. So I would discount it using the rate of 11%, which means 1.11 raised to the power minus raised to the power minus number of years. It's year 0. So it is then similarly copying with each year. Then our net present value would be 0.1 into 800, which means 800. Then it is 180 for the 1 year, 234 for the second, 246 for the third, 203 for the fourth, and so 5, 6, negative 6 for the fifth year. Then our net present value altogether. So our net present value of the investment project is 57. Sir, you have to advise whether you should accept the project or reject it. Sir, since I am getting a positive NPV, so therefore I should, since there is a positive NPV, therefore I should accept the project. Since sir, it is a positive NPV, so it is viable to accept the project. Then sir, we have part 2 in which we have to calculate the we have part B in which we have to calculate internal rate of return. Okay, sir, we have to calculate the internal rate of return. Uh, sir, at 11%, sir, at 11%, we are getting at 11%, sir, we are getting the NPV of 57. At what percentage we would get the NPV of negative NPV? Sir, therefore, I would calculate the negative NPV. We have to calculate negative NPV, so I would simply copy the number of years within net cash flows, copy number of years, which means that number of years here. Our net cash flows would be our net cash flows would be 800 for the first, 200 for the second, 288 for the third, 336 for the third, and 308 for the fourth year. Then we would use the discount rate. Sir, it is a judgmental. At what rate you would discount that you would get a negative NPV? As earlier I told you, the lower the rate you would be getting, you would get a higher NPV, and the higher the rate you would be using, you would be get a negative NPV. So the maximum rate I assume it would be 20%. So sir, I would be using a 20%, which means 1.2 raised to the power minus. So sir, similarly After using 20%, I'm getting 0.83 for the first, 0.69 for the second, 0.58 for the third, 0.48 for the fourth, and 0.4 for the second year. Then I would like to calculate the net present value. Net present value is calculated by multiplying the discount rate with the net cash flows, which is 800 for the first, and similarly I would copy all these figures in each of the following years. Then I would calculate that, so I am getting, okay, so then I am getting a negative NPV of minus 94 at 20%. At 20%, I am getting a negative NPV of 94. Sir, as you guys know earlier, that we have a formula to calculate the internal rate of return. That is internal rate of return. We have the formula. Internal rate of return is equals to A plus A upon A minus B into B minus A. So sir, therefore I would copy all these figures. Sir, we have initially step one, you should subtract the positive NPV with the negative NPV, which means a positive NPV of 57 is subtracted with the negative NPV of minus 94. After subtracting it, we would get a positive 151, then 151, then we will subtract, divide 57 divided by 151, A divided by A minus B, which means we would get something in points. Okay, sir. Then sir, our B minus A, I would also calculate B minus A is equals to 20 minus 11%, which means your B minus A would be 9%. So I would 0.37 would be multiplied by 9%, which means you would be getting 0.03. Then 0.03 should be added with A, which means your A is 11%. So sir, similarly, your IRR would be, sir, your IRR is 14.37. Okay, sir, we have calculated the part B of the investment project, which means your IRR. You have to calculate the IRR. Sir, your IRR is 14.37%. Sir, you should advise. So, in part B, you also have to advise whether you should accept the project based on the IRR or not. Sir, since our target profit or target benchmark or target return, which I was expecting, was 11%, target percentage that I was expecting is 11%, and the IRR which I am receiving it's 14.37% is 14.37%. Therefore, sir, I think so that I should accept the project because our internal rate of return is greater than an IRR which I was accepting. So it is feasible or it is good for you to accept the project that you will get benefit in future. Okay, sir. Then we have part C. In part C, you have to difference between the risk and uncertainty. Sir, initially I would define you. Initially, you have to write the difference between risk and uncertainty. Firstly, you have to write the definition of risk and then the definition of uncertainty. Risk. Firstly, if I would tell you what do you mean by the risk? Risk refer to the situation when you have variable outcome, but the probability of each outcome can be determined with confidence. In risk, you can determine the probability of each outcome with confidence. But in uncertainty, when you have several outcomes and the probability of each outcome cannot be determined with the confidence. In uncertainty, the probability of each outcome cannot be determined with confidence. In risk, sir, risk can be quantified. So using a probability or sensitivity analysis, you can quantify risk. You can get how many risk, what percentage of risk you are having or you are facing. Similarly, you cannot quantify your uncertainty. Uncertainty cannot be quantified, whereas uncertainty would increase over time. Okay, sir, it is clear that you have a difference between a risk and uncertainty. Then moving forward, you have to describe. Sir, the question also says describe how risk and uncertainty and how sensitivity analysis and probability analysis can be used to incorporate the risk and uncertainty in an investment project. How can you incorporate your risk and uncertainty in an in an investment project using a probability analysis or sensitivity analysis? Sir, there are only two methods. First, sensitivity analysis and probability. And second one is probability analysis. Using these two methods, you can incorporate, sir, risk and uncertainty in your investment appraisal project. Okay, sir. If I would tell you, what do you mean by sensitivity analysis? Sensitivity analysis means, sir, how much changes in the variable, which how much adverse changes. Sir, remember, how much adverse changes in your variable would make your NPV zero. How many adverse your negative how many negative changes in your variables will make your net present value zero. It is mean by the sensitivity analysis. Okay, then what do you mean by the probability analysis, and how would you incorporate risk and uncertainty with your probability analysis? Probability analysis means that project in which you have several variable outcomes, and the uh, and through different outcomes you can come up to the probability of the expected value. Using a different probability, different outcome you can use to get one expected value. It is known as the probability analysis, and you can use this sensitivity and probability analysis to incorporate risk and uncertainty in your investment appraisal project. Okay, sir, our part C is also clear. Hope you guys would understand this. If you have any queries regarding this, you can also uh, WhatsApp me or write in the comment box your query. I will hopefully reply you all. Thank you, guys.